Okay. Today we're going to talk about Module 1, which includes Bode Marcus Chapter 8, so from the Connect textbook, and Montier Chapter 1 and Marcus Chapter 2. This is by me, and we'll get right into it. So we're going to start with Bode Marcus Chapter 8, which is the EMH, or Efficient Market Hypothesis. We can really break down the efficient market hypothesis into three different divisions, beginning with weak form hypothesis, which basically starts with the very simple pieces of information that are given to investors. Let's say past prices and trading volume, which these two are relatively available to any investor that can just look up the ticker and their historical prices and perform some kind of analysis. And then short interest. So how much short interest there is out against the stock also falls under that weak form hypothesis. So with just these two, it's very hard to make conclusive evidence about a stock or a conclusive decision about a stock. And then we have semi-strong form hypothesis, which really covers a lot. And that's why it's called semi-strong and not semi-weak, I guess. So we begin with fundamental data. So the fundamental data of a stock is readily available to the investors, which includes a lot of things like the income statement, the balance sheet, statement of free cash flows. I mean, you can make a good amount of assumption or conclusion based on these three financial statements. Beginning with the income statement, it'll show the revenues and the costs for the company during that quarter and result in a net income. So whether the company made money that quarter or lost money that quarter. And then the balance sheet, which is essentially just a snapshot of the firm's assets and liabilities, assets on the right and liabilities on the left. No, sorry, assets on the left and liabilities on the right. And they're organized by most liquid to least liquid. And then lastly, cash flows or statement of free cash flows, which to investors is probably the most important. It'll show cash inflows and cash outflows for the quarter. And a good amount of analysis can be drawn from this statement. Then we have management structure. So how the firm's management is set up. Investors love to know who's on the board of directors, who's able to make decisions, the hierarchy within a company. And then lastly, ratio analysis. So it's a lot of different ratios we use out there, and they can easily be calculated with just a little bit of information from the company, especially because these are publicly traded companies. Those are all readily available. And then the last form is strong form hypothesis. It incorporates weak and semi-strong information. So all the previous information we just mentioned with insider information. So the most useful information in essence is insider information. So information that the top dog of a firm knows. So the CEO, he or she is obviously aware of everything that goes on within the company. And any information they have or give to anyone would be considered, that's not readily available to the public, would be considered insider information. Okay, and then we talk about Montier and Mark and what they think about the efficient market hypothesis. So beginning with Montier, he generally disagreed with the efficient market hypothesis, and he explained that through three anomalies that he focused on, beginning with value, and then momentum, and then neglected anomalies. So we'll talk about momentum first because it's the easiest to explain, which means if a stock has performed good in the past, then it will continue, or if a stock has performed good recently, it has momentum and it'll attract investors to invest in that as soon as possible. So let's say Apple's been performing really well in the last month because they released a new product, and investors see the green chart going up and they're attracted to that stock. That's the simplest to explain. And then we have value, which he uses small cap stocks, so stocks with a lower market cap, to argue that they perform better than other stocks, such as longer term holds that might come to mind. And he claims that this is unfair, or it makes the market inefficient, because let's think of a small cap stock. I can't think of one off the top of my head, but how can a smaller size tech company perform better than Apple, for example, in the long run, in a perfect market? And then lastly, neglected anomalies, which is basically the companies that are not studied by analysts or don't have articles published by analysts, and are often overlooked, which seems to be unfair in an efficient market because information about that company is not readily available. And then we talk about Marx. He took generally a neutral stance. So he talked about the efficiencies and the efficiencies in the market. And some of the important things he said was that he claimed that the prices of an asset reflects consensus views. So the majority opinion would reflect in the price of, or in the current price of an asset. And then he does point out that to be efficient or to outperform the market, to do better than, your average investor and everyone on Wall Street, you must challenge the consensus. I mean, I'll use an example here. So back in 2008 or 2007, the global financial crisis, you had the majority of investors who were confident in the market at the time and had no fear that there was soon to be a large default on mortgages, which would then trigger sharp decrease in the price of debt securities and equities later on. So they were unaware of that. And then there was that was the majority. And then there was a very small group of investors. For example, Michael Burry, who took a short position, or he bought credit default swaps on the market and on those CDOs, which means he bet against the market. And he was right. So he challenged the consensus and he outperformed the market in a time that most people, 95% of people, lost money. So that's essentially what Marx is saying here. And that's about it. Thank you.